assure my clients that things will get better because our government will help. But I'm glad that most of my clients trusted me. We went through the crisis. And then when the COVID came, right, this time around, I can tell my clients with full confidence that it will be okay. Because I had already more experience, more knowledgeable about economics and investments. A lot of people thought that I work best with high net worth. That is not necessarily true. I work best with people with positive personality. So I like to work with people with a positive outlook in life, because financial planning is about creating hope for people for a bright future, having a wonderful golden years in their retirement. Actually, I don't like to use the word retirement because it sounds like retired. Retired sounds like retired from life. But rather, I would say maybe a more appropriate word that most people are using is called financial freedom. Freedom from what? Freedom from the necessity to work. Okay, that does not mean that there's no work. That means that you are free to work in anything that you like. There are others, on the other hand, decided to continue with their existing job. I know of this guy, this client of mine recently I met. He's already 67 years old. He was a senior person in a civil service. However, he likes to continue to work, and right now he acts as more like a support role. And so he said that he'll do all the back end, and the younger people who are the senior person will get the credit. But he said it's fine. And that's his retirement job. Hello, everybody. This is wilfred Ling speaking, and good afternoon to all of you. In order to make sure that the IT is working fine, if I may ask a favor, could you type 1 into the chat so that I know that you can hear me and that you can also communicate to me through the chat. Please type 1 into the chat. Thank you. Thank you, Hong Han, Vivian, Colin, VC. Is that all? Oh, yes, there's more. Thank you, thank you. All looks good. So for some of your settings, I only can see your chat. So you need to switch your chat setting to everyone so that everyone can see. Otherwise, only me. So for example, like Hong Han, I only can see you. Colin, I can only see you. BC, JQ, I only can see you. Kim only can see you. Yok Leong, only I see you. Clement, only I can see you. Charles, only I can see you. So please don't mind you. For those I mentioned your name, please switch it to your chat setting to everyone so that everyone can see. Thanks, Terry. I can see your chat and everyone can see your chat. All right. So okay, Aaron, thank you. Right. So let's begin this. I hope to keep this in less than 1.5 hours. In fact, I know many of you are having lunch and also listening to this, and also you have your own methods you're doing. So I know that you are multitasking. So I will try to make this short and sweet. Thank you for coming to this webinar. My name is Wilfred Ling, and I'm the Wealth Advisory Director with Financial Alliance, which is the largest independent financial advisory firm in Singapore. And my experience is 17 years. Hong Han said that you cannot see me or my slide. I have not shown any slide, but you should be able to see me. Can everyone see me in the first place? If yes, please type Y into the chat. Oh, okay, I can see it. Right. Okay, good. Yeah. Okay, let's begin. So what I'll do today is the agenda is shown on the slide I'm sharing with you now. The agenda is that I will have a market update, and then I'll review some of the Singapore stocks that you already have or most commonly have. Some of you actually, after registration, immediately asked me that when you saw there's a review on stocks, so you reply to my email, my reminder emails that oh, you have this particular stocks that you are concerned with, and usually it's always making losses and those who make gains, they were not going to ask me. So you ask me what I think of them, and as well as some of the opportunity for investment. That's what I'll cover today. And then at the end of the session, I also I will ask you to consider my financial advisory services if you feel that this webinar makes sense to you. All right. Okay, let's begin. Where's my chat? Sorry, I lost my chat. Where's chat? Okay, it's here now. Okay. So this is the disclaimer that this webinar is not financial advice. It's more like a general information. However, if you need financial advice, you will need to engage me on a one-on-one basis. Right. This is the 1 month performance of November performance 1 month. Most market is up. Majority is up. S&P 500 is 1% up. The global market is 1%, more than 1% up. Uh, Nikkei Japan is 5% up. Even the Russian is 11% up. Okay, so it's been a good month. And for year to date, for this entire year, it has been a good year too. The world index is nearly 10% up. The US market is 13% up. So it's been a rather good year for the stock market, despite the fact that we had bad inflation, despite the fact that we have a Ukraine war that is not it don't seem to be it seems to be a forever war. We also have a Middle East crisis, which strangely does not affect the market at all. So it's been a really good year this year, despite the very pessimistic outlook. And that's why investment is art sometimes rather than a science. Okay, the returns from the stocks can be broken down into as following. You notice that this is the year to date. The Nasdaq has been giving a more than 30% return for this year. And the rest of the index, like the black color is the S&P 500, which is a broad market. And the rest, like Russell 2000 and so on, focuses more on the small companies. So from this, you can see that firstly, it is the technology stocks that is doing well, not so much on others. And the smaller firms are actually not doing well, or in fact, some of the smaller firms are actually losing money. In particular, it's only the Magnificent Seven that is making lots of money in terms of stock price. Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla are the what I call the Magnificent Seven, are the one making lots of money. So if your portfolio does not have any of those, it's likely that your returns are flat or even losing money. But nobody will put a lot of money into a single stock, right? I mean, nobody will put all your money into a Magnificent Seven. And definitely, most of us, our portfolio would have been, significantly giving less return, and that is to be expected. In terms of technical view, I want to highlight to you that there is a similar pattern as currently right now. We have this V-shaped pattern in right now. However, this pattern appears in .com and great financial crisis. So let's look at the 2023, the 2008, which is the global financial crisis. So this is a global financial crisis, and if we to zoom in, you'll find that there's a V shape, and then we call it the coast is clear, and then followed by the breaking of the camel's back with a major sell-off and a result of a major decline. In the year 2000, is something similar, the dot-com bubble. We had the V shape, the coast is clear rally, followed by the breaking of the camel's back, and we have a major decline where the investors just throwing the towel and sell off. So at this point in time, we appear to have this V shape as well, right? 2023. We have the coast is clear rally, a V shape, and the question is that will history repeat itself? We call the breaking of the camel's back. Okay, so that is why there is a lot of apprehension in the market or whether the camel's back is going to break off like in the past, causing a major decline. In fact, in our in-house view in Financial Alliance, we assign a 70% probability that the markets or S&P 500 will decrease to the 3,000 range. Right now it's 4,500 points, and there's 70% chance that they're going to fall into this range because there's a 70% of a normal recession. Okay, that's a normal recession. So what is the reason why the past 1 or 2 months there has been a rally in the stock market? It's because of the interest rate pause. So for those of you who are not familiar with economics, the there's a relationship between inflation, interest rates, as well as GDP growth. Okay, GDP is a measurement of the economic output. So what is the relationship is that when inflation is high, like the last 1.5 years, central bank like Fed would increase interest rate. So by increasing interest rate, it serves a few purposes. One is that the cost of businesses goes up. Okay, the cost of business goes up. Yep, and when cost of business goes up, there are going to be a pay cut or pay freeze or even a retrenchment, to cut costs, right? So when that happens, people are going to spend less. So when the demand for goods and services drop, hopefully the price doesn't goes up so much or even decline. But when the demand for goods and services drop, businesses will also be affected because the revenue is going to decline. And revenue decline, they are going to retrench more people. And so the cycle continues until the goods and services, until inflation come to a manageable level, and that's where the interest rate stop increasing and we have pause. So right now we have pause. Right now the interest rate is paused, and people feel that yes, at last the Fed is no longer trying to get the economy into recession, and that is good for businesses. Another effect of having a high interest is that people will look at opportunity cost, right? So if they look at, okay, if I put in a bank or a short-term deposits, I will be able to get a high interest. So people tend to put more money in the bank than to spend it. So again, this actually results in lower spending and decrease in demand for goods and services. Right. So that's how inflation, interest rate, and economic growth are related. So right now we see a pause. So a pause is good news for businesses, and in turn, good news for equity market, stock market. That's why there's an increase. Right. Another reason. Another reason for the good news for the bond market. So the bond markets are having a rally as well. Long-term bond is appreciated. It's because the Treasury is expected to increase the size to issue 2 and 5 years notes by $3 billion a month instead of the long-term one. So that means the long-term issuance of bonds is not under pressure anymore, and so the yield for long-term bond is being appreciated. As on 12 October, the futures market predict that we will see a decline in interest rate in June in 2024. So how do you really stable is this? These are the meeting dates of when the Fed meets to decide what interest rate to set, and this is the interest rate that it sets. So for example, there is in the December meeting that is a 66% chance that the Fed is going to set the interest rate at 5.25%, which is a pause. So if you look at the highest probability, the blue color, you'll see that as on 12 October, the future markets is pricing in a decline in interest rate on the 6th, in the June 2024. However, a month later in November, you'll find that the decline is predicted to be fifth month, which is May, right? May 2024. So that's also another reason why the market rallies. Okay, now all these numbers, right, you may ask, like, so how do we mix in all these numbers? Like, yeah, Wilfred, thanks for the information. How to make use? So all this information can be strategized into investment planning. Take for example, increasing interest rate is bad for bonds, right? The bond price tends to drop. But if we know a roadmap where number one, interest rate is going to be assumed to be paused and going to decline, and decline interest rate is good for bonds, then you can actually do what I call dollar cost averaging in bonds until maybe in May or June. Okay, why dollar cost is maybe because it's just to mitigate the risk of just in case the interest rate goes up. But you just do dollar cost until June. So let's say you have a sum of money, you can do dollar cost averaging until June. Otherwise, you do not know dollar cost to which date, right? If it's too far off, maybe 3 years, 4 years later, you will have suffered a huge opportunity cost. So this is an example of how you can price in how you can strategize using this kind of information. Let's talk about recession, right? Because we can't talk about inflation, recession are all related. So there is this indicator called the sham signal, which is actually the difference between the current jobless rate and the 12-month low. So if you take the difference, and it's been back tested and shown that wherever this difference actually exceeds 0.5%, it follows uh, then you have a recession. So the blue line here is the sham signal, and the gray color represents the inflation. Okay. Yeah. So right now, once it exceeds 0.5, it predicts recession. So right now we are here. Okay, we are here, starting to reach 0.5. So once it's 0.5, it predicts recession. Now, it's the same sham signal, but we superimpose on the S&P 500. So wherever the recession occurs, the stock market decline. Okay, it always happens. Usually it happens. Okay, so that's why our in-house view is that the S&P 500 should decline to 3,000 plus point range when recession occurs. 70% of that probability. This is another indicator to say the same thing. The Conference Board linear economic indicator is an indicator to predict the economic growth. So wherever the indicator, which is blue color, goes to negative, you have a recession. Okay? So right now it's in negative territory. Okay, so this the blue color here is the difference between a 10-year treasury and a 2-year treasury. So when a 10-year minus 2-year treasury, we call it the yield curve is upward sloping, and if it's negative, it's downward sloping. It's been shown that when the yield curve goes negative and start to rise up again, recession occurs. So every time when it rise up, when the yield flattens, recession occurs. So right now we are here where it's rising to 0. So once it rises up, recession occurs. So all these slides, they're all talking about the same thing, which is the coming recession. Now, for those of you who are holding bonds, then do be careful of what kind of bonds you're holding. Because every time when there's a recession, the bond default rate shoots up, corporate bonds or speculative rate bonds. So this is the probability of default. So be careful of what kind of bonds you're holding, especially if you are dealing with the private banks. Very often they will sell you what I call a bond, typically 200 or 250K, and with an attractive yield. Just be careful on those, because if it defaults, you lose a significant amount of it. Okay, just be careful on that. So stick with investment grade bonds. If I were you, just stick with treasuries. Some people have noticed that the yield of the 10-year treasury now is on par with equity. So what it means is that investing in treasury right now is something that cannot be ignored. So one of the strategy that many people advocate, and even I advocate to some of my clients, depending on their investment objective, is to buy long duration treasuries to maximize the sensitivity. What I meant is that you buy long treasury first, and then so that when interest rate drops, you have a significant capital gain. Okay, and then when that happens, right, when interest rate drops, it's likely you see a rally in the equity, and then you switch to equity to enjoy the upside. And so there's a very common strategy right now. However, there is a downside to it. The downside is that the treasury yield may go up instead of coming down, the long-term one especially. Okay, why? Because of the budget deficit. So the US has a very large budget deficit. The chart here, the vertical chart here shows the budget gap in terms of GDP percentages. The US is negative nearly 15, means that the amount of budget deficit it has is nearly 15% that of the economy, of the GDP. Okay, so the more negative, the worse it gets. So the US right now is budget deficit is worse than the Portugal, Ireland, and Greece. We call it the PIGS because the economy has not been very fantastic. And so the US budget gap is worse than the PIGS. So what they mean is that if you do long treasury and then hoping to switch to equity later on, that strategy has risk. The risk that it may not even work. Okay, because the US 10-year or 20-year bond the yield may go up due to the ongoing budget deficit issue. Okay. Okay, this is the end of market update, and now I will switch to the next agenda. Give me a moment. Are you able to see my slide? Sorry, I just share another slide. If you can see, please press Y and see. Thank you, Colin. Hong Han, thank you. BC, thank you. Okay, Stephen, thank you. All right, let's see how many people are here. Wow, nice. 198 of you are here. Okay. Yeah. So let's continue. So what should you do, right? After listening to the market update, the most important question you may ask right now, you come to here is not to hear my update, but is this, some of you is wondering, right, you may be in a situation where your portfolio is making losses and you are wondering whether should you cut loss or wait for your investment to recover. Okay, you are confused over too many investment options, no time to monitor, regret not taking profit earlier, or regret not cutting loss earlier. So these are valid questions which I hope to address by giving you some examples of stocks that you asked me to take a look. So let's examine some of the stocks that you may have owned. These are owned by many of you, and you asked me to look into those. Okay, so I will just look into those. Okay, let's go to the next one. So some of the common stocks you may own, for example, like sets. Okay, like sets, right? So for sets, some of you own sets because you bought through the dividends. In fact, I have one client who used to work for sets, and his entire stock portfolio is just this company because he said it's the best in the world. So of course, I asked him to diversify. He did diversify a little bit, but that's all. The majority of portfolio was in sets. Now, sets prior to COVID did very well, but after COVID, something changed permanently. If you look at the free cash flow here, okay, that's what I'm highlighting here. Free cash flow here, it turns it drops, and then it just drops drastically and never seems to recover from COVID. The entire year of 2023 is actually, we are already post-COVID, but it never really recovered from that. Okay, I'm going to share my entire screen easier. And see, okay. So these are the stocks I'm going to cover. So as a result, the share price has actually came down by a lot. So this is set, and in fact, in 2019 onwards, before COVID, the share price has already declined and it's become bearish. So if you have, let's say, invested in 2017, you have made a loss of 20%. Most reasonable stock, if you invested in 2017, is not at a loss at this moment. It's actually profitable, despite the fact that there was a COVID in between. Even if you factor in the dividends you get, it's still at a loss. Okay, so there's definitely something wrong with this firm. Okay, let's go on to the next one, which is Singapore Post. So for Singapore Post, right, in the earlier years, the revenue has been increasing. The green bar here represent the revenue, and then the line represent the net profit. So earlier years has been increasing in revenue, but somewhere in 2017, the revenue start to decline. Okay, start to decline. So this is way before COVID, right? 2017 it start to decline. So you see, if it continue to decline, actually is also a dying company. Okay, it's a dying company, and I also do not know exactly what is the value proposition of Singapore Post. I have no ideas. Like also read about it. People barely send physical letters anymore, and in terms of uh, the last mile delivery, there's so many competitors, right? So you know, one of the things that when you invest in stocks is that you must ask yourself, like in 10 years time, will it be around? Okay, I, Singapore Post, I'm not so sure. So if you look at Singapore Post, the is sorry, it's not Singapore Post. I think it's better search by the code. Yeah. So starting from 2015, it has been a large decline. Okay, it's a large decline. In fact, you can even draw a trend line. It has a regression correlation coefficient of 97%, 0.97% on this trend line. Very strong downtrend. So this is despite the fact that you are taking a lot of dividend, but so what, you have dividend, right? Your capital is lost, 70% decline. So I would say that no need to wait really lah. No need to wait. Next will be Bitcom. So Bitcom is an inspection company, vehicle inspection company, and you notice that since 2013, the revenue, which is highlighted in the green bar, has been almost the same for 10 years. Now, can you ask, like, how can the revenue be the same? Does it charge the same inspection fee for over 10 years? I mean, for those guys of you guys who send your vehicle for inspection, have you been paying exactly the same fee for 10 years? No, right? And in fact, I'm sure Bitcom's cost of business goes up with inflation as well, right? How can he be paying exactly the same salary to his staff? Cannot be, right? So how come the revenue is the same? Okay, now we need to adjust for inflation because there is inflation. So if revenue is the same in nominal terms, that means after inflation, the revenue is dropping. Okay? So this is like Singapore Post where it's declining business. Let's look at the stock. So, okay, trading view, okay, this trading view does not have data before 2013, not so sure why. But anyway, the share price has been declined by a lot. So, I mean, okay, I know a lot of people say that, okay, 2021 is a special year because a lot of stocks were down too, right? When inflation become an issue and when Fed start increase the interest rate. But 2022 and 20, I think right, from October 2022, the market actually started to rally, but yet the stock price is down by 16%. But I'm more concerned with not so much about what the chart is saying, is that why is the revenue declining after taking inflation? It's something like when you drive a car, if you stop at a highway, you're not stopping at a highway. Relative to others, vehicle who is moving, you're actually moving backwards. So when revenue is the same, that means after inflation, you know, and the fact that all other companies moving forward and economy is moving forward means the firm is actually declining. Let's look at ComfortDelGro. So ComfortDelGro has the same picture where the revenue is almost the same, net profit is almost the same. After inflation, it's actually declining too, and the share price also is a reflection of that. So let's look at before COVID, like 2017. It's like, my goodness, like something happened in 2016. So after 2016, the share price has been going downhill. Yeah, it has been a long-term trend down. Okay, and yeah, so it used to be $3. Now it's at 134. Okay, so the share price is on a long-term basis does reflect the prospect of the firm, and the share price is already saying the same thing as what I mentioned, that it's a declining business. Now, share price on a short-term basis does not move necessarily in tandem with fundamentals. Okay, it's more on demand and supply. But long-term, yes, it does reflect the prospect of the firm. So Comfort Delgro is something which I don't think is something that is you can consider. StarHub. So StarHub revenue is almost the same, but what is the line here, which is the net profit, is actually the net profit is declining. Okay, so let's look at the chart for StarHub. Let's look at 2014. So since 2014, the share price has been dropping non-stop. It's actually a long-term trend down. Okay, so let's do a regression. Yeah, 95% correlation coefficient. Okay, for the regression of the downward trend, is actually really a downward trend. And a lot of people again buy this because of dividend. But you see, when you buy dividend, you need to look at the capital. Okay, what's the point of having 5% dividend when your capital is you make a massive loss, right? Okay, and Singtel. So Singtel is the same story where revenue is the same, and after taking account of inflation, it's actually declining. So let's look at the stock price. Stock price since 2017 is declined too. Wow. Okay, 90% correlation coefficient. Okay, it's actually 90% on the downward trend. And Capital. So Capital as revenue actually has dropped since the past. And let's look at the stock price. Okay, so the stock price recently has appreciated in value. I believe it's because of if I'm not remember correctly, because of the green energy team. Okay, I'm not so sure. I believe so. I think this is the one. So there is a new business in green energy. Okay, but let's see. Okay, because on some 2030 the revenue is exactly the same. And but anyway, there could be better other green energy company. Okay, let's go at Genting, right? Genting, after COVID, it did not recover. 2022 is also way below. And the stock price says it all. The stock price is downward since 2011. Okay, 2011, it's been down. So it's important to also ask like whether is the stock share price down because of market sentiment or something that's temporarily like COVID. But you see, like things like Genting, right? I mean, we go all the way to 2011. That is really, really long way, That's so long ago, right? And it's been a long-term trend down. Okay. So so we can't blame it on COVID or recession or inflation. No lah. I mean, 2011 is more than 10 years already. So the stocks that you guys have asked me to take a look at, these are stocks that which I don't think you want to hold for forever lah. And if you think you're going to recover, then you need to ask yourself whether is there a competitive advantage of this company? Seriously. So if you can't answer that, right, you're going to have a issue with that. Okay. Okay. Let's look at REITs. Okay, these are some REITs. There are many of them. So if you have whole REITs, you realizes that it's actually having a massive loss. So there's a reason for this. So when interest rate goes up, the cost of borrowing for the REITs increases because REITs inherently is allowed to leverage. So and most of the loans are floating. So when the cost of borrowing goes up, it actually eats up into the profit, okay, the bottom line. And the value of the asset also decrease. Why? Because as interest rate goes up, we call it the discount rate also goes up. So when you value a asset, you need to know what is the discount rate. When discount rate goes up, the value actually drops up. So the risk is having two you know, it's been affected by two areas. One is higher cost of servicing the loan and a decline in asset. So that's why the price of risk has dropped by so much. And then also there's sentiment of worry about tenant, you know, going bankrupt or downsizing because of economic reason. So if that really happens, then it will affect the rental income. So that's why risk has been hit by all over the place. I would say that is probably actually personally I find that it's best to do dollar cost averaging over the next 6 months, but maybe not in individual REITs, but more on the ETF. That's what I feel, and I'm doing for some of my clients to do that as well. Okay, so those are the review of the REITs and Singapore stocks. The question is that what are the investment opportunity that we can have, because the only time to buy low is when there is bad news, right? So I'm talking about recession and so on. So what are the opportunities? So how I help my clients in stock investment is that I'll look for companies that have strong competitive advantage. I'll talk about that next slide. And then I'll look at the fundamentals. Fundamental, I don't have any more demonstration on how to do it, because I already showed how I do a simple one for some stock. I mean, by looking at revenue, net profit, free cash flow, any contingent liability. That means liability that don't appear on balance sheet but actually is there. And I look at the growth of its bottom line as well. So fundamental analysis is done on the second step. And then once I created a watch list of companies that fulfill number 1 and 2, then I will wait for the right time to ask my client to buy, which is based on technical analysis. So I merge both fundamental analysis and technical analysis into one. Fundamental analysis is strictly not necessary to get good returns on the long term. Personally, I feel so, but it's necessary for psychology reason. Because I mean, if you invested in Amazon in 2000, you have lost 90%. But if you hold, you have made a huge gain anyway, despite the 90% loss. So that means if you buy into very good company that has strong competitive advantage on fundamentals, you can just hold long term, and likely chance you'll get it right, unless there is a fraud involved, or there is actually or the fundamentals become bad or got worse. So timing is not crucial actually for long-term investing. However, because of psychology, all my clients want to see some profit as soon as possible. They don't want to wait for 3 years, 5 years, 10 years, or 100 years. They want to see see something at least, or maybe they want to buy when it obviously is on the sharp decline or in a correction. So that's why I use technical analysis. Sometimes request me that don't do technical analysis for portfolio because they are not going to lock in for the next 10 years. So okay, fine, fine with me. So what are the competitive advantages I talk about is listed here. These are some of the business model I look for. Give you these are some jargon. Take for example, like let's say let's say switchboard platform profit, right? So a company that has this switchboard / platform profit is like Amazon. And what it does is that the platform matches between buyers and sellers. So as a middleman, they earn a commission. So this is called switchboard of platform. Okay, or maybe the de facto standard profit. So de facto standard means the company is in a business where everyone uses its product or services. Example, Windows, right? So Windows is a de facto operating system, and for everyone, even the Mac users sometimes have forced to use Windows. Okay, so it's a very good business where everyone is using it, and so they make money from everyone. Okay, how about emotional brand profit business model? This is where companies sell because of able to sell its product because it's brand, and people buy buy branded goods because of emotional reason and not necessarily because it's really good. Example would be some of the expensive handbags like LV, Louis Vuitton, Apple products. These are very branded goods, but they are also very expensive, and the cost of manufacturing those are actually very low. But people still buy. So many Apple fans they buy everything Apple, although it's 100% more expensive than something similar. Although in terms of feature, it's not 100% more. In fact, I have an iPad, a brand new one, I just bought a few months ago, with so many bugs. I found so many bugs which, you know, the file system has a lot of bugs in it, and it's not fixed after so many months. And it's not necessarily better, but people buy because of emotion. So when people buy because of emotions, that means they're willing to pay a higher price. Good lah, the stock price will benefit. So these are some of the example of business model that I identify and will recommend to my clients. Now, it does not mean that if a company has a business model that's on a list, means definitely is sure no problem. Take for example, like Singtel, StarHub, and M1. They have this business model install base. That means that everyone uses their product. Now, even if you are out for Republic or Circle, end of the day, the back end is actually run by these three companies only. Singtel, StarHub, and M1. So really, these three companies is like almost like oligopoly. Everyone is using their products. So this kind of when everyone is using, right, it's called install base. Everyone is using because they have a recurring income, right? When everyone is using, but they are not necessarily good. Why? Because they do not have high switching costs. They do not have this business model called high switching cost. That means what I'm saying is that people can actually switch from one provider to another provider without cost. In fact, sometimes you make money by switching, right? Because you get something cheaper. So because there's no switching costs involved in customer switching from one vendor to another, this telco that I mentioned have no competitive advantage. Okay. High switching costs are examples of one example is like maybe the business model creates a software, let's say a human resource software, and then this human resource is used by a lot of people, and then as a result, it's very hard for a firm to switch vendor because it's all integrated. It's so hard to do it to switch to do it because the whole company is relying on it. So that's called high switching cost. I have stocks that I recommend a client based on the high switching cost. Okay. So this the first step. Remember, the first step of identifying opportunity is look for company that has strong competitive advantage. Then the second one is fundamental analysis, which is I already demonstrate to you in a very simple way on earlier slides. And then wait for the right time. So wait for the right time. What I mean by right time is look at technical analysis. Take for example, like this company. It's a very large company that sells branded electronic goods. So the business model is emotional branding profit. And looking at the technical analysis, here is a pattern called the falling wedge, which is actually a bullish pattern, and also a continuation pattern. We call it a continuation pattern because prior to that, it was already on a bull run, on an uptrend. And so this is a continuation pattern. And then now the price has already surpassed the what I call the resistance level, and then it's expected to go up further. Okay, so when it surpasses around this line, I give a margin about 3 to 5%. I'll ask my client to buy. Okay, that would be called the right time to buy. Okay, but if it's here, I will hesitate for my client to buy. I wouldn't recommend. But for those who say don't bother about TA, yes, I don't get even buy here is fine because eventually you will still make money, except that you have to wait a few months. Okay. Now, this is a large cap software company providing services to architecture firm, engineering, construction, manufacturing, media, etc. And here is what I call a symmetrical triangle. So a symmetrical triangle can go both ways. It can be a bullish pattern or a bearish pattern. And so I'm now waiting for the price to surpass the resistance line with some margin, extra margin for margin of safety. And once goes up, you're expected to show up further. So when I look at this, what I'll do is that I won't ask my client to buy, but I'll do what I call a buy stop order. Buy stop order, put a price higher a bit, and then once the price reach that target, you will buy. Okay, you will buy it at that because it's bullish because of the bullish pattern. But if it does not happen, it does not reach the price, you expected to drop, so didn't buy, so you avoided a loss. Okay, now there's also another large cap entertainment company. So this entertainment company is also on a falling wage, and then has the same, and then it has actually already surpassed the resistance level, and purchase is done. So if it's on the way down, I wouldn't ask my client to buy, but once the pattern emerges, I'll ask my client to buy. This is a medical company, and actually it's on the long-term trend down. It's a long-term trend because you can see the price is actually within this downtrend channel. So it's actually bearish. But nevertheless, we still can trade on this bearish pattern by, let's say, buying at the low point here, which I did. I asked my client to buy at a support level here. And there is a 20% upside. Okay, after 20% upside, do I ask my client to sell? Not necessary. Firstly, if it's a company with strong competitive advantage and good fundamentals, I may even ask my client continue to hold even if it reaches resistance level. But some wishes to take a profit, no problem. Once it reach there, I'll put what I call a sell stop order here. So a sell stop order is that it only will sell only when the price decrease. But even sell is only partial sale because it's good for long term. But if the price continue to go up and actually surpass the resistance level and thus making a support level, then no selling happens and the entire investment will start to enjoy the new uptrend. This is a fast food restaurant that I saw in 2021, and actually is on a long-term trend. Okay, 2022, a long trend up, and now it's at support level. Excellent time to buy. This is a media company. A media company after it came down significantly in 2021 and 2022. Okay, it's now on an uptrend channel. So this is an opportunity to buy. So this another company is a rubbish collection company that that's in this triangle. It's a falling wedge triangle, and it's almost going to surpass the resistance level. And once it's done, then I'll ask my client to buy. So you can see that there's a lot of opportunity in the market. Okay, if you do stock investment, there's always opportunity to buy. It's only how to dig it, how to find. For me, I don't go for just pure TA. I'll look at fundamental first, and then go look at the technical for some of my clients, like if they want to. Okay, and even if the TA don't get it right, because it's just, TA is not, it's not 100% foolproof, right? Sometimes you get it wrong. Even let's say, example, like this surpassed the resistance level, and I say, oh, buy, but it could actually come down. It could be a false breakout. So how? It's okay because these confirms are all strong fundamentals with good competitive advantage. It's good for long term, so it's okay. It will increase again eventually. Now there are some stocks that are not good for long term. Example is Tesla. I find that in terms of the business model, the EV market right now is now getting a bit crowded. The Chinese competitor like BYD is becoming a strong competitor to Tesla. Yeah. And then what is worrying is that every time when Elon Musk tweet, the share price will drop. Seldom does he tweet and share price goes up. In fact, if he tweet and share price goes up, he will be accused of market manipulation. So it's always going down, right? When he tweets. So it's not good for long term, but still can do some trading. For example, like when you identify a long term trend, you can actually trade, buy here and sell here. This is exactly what I did for my client: buy here, sell there, right? And then when it's a trend, I can buy here and then sell, and then now it's a downward trend. So now it's actually on the resistance level already. It's probably time to sell. Okay, so you still can sell, and this distance between both, it can be as large. This one can be large as 50%. Can be. So yeah, Tesla is an example. I trade. It's not for long term, but I seldom trade for my client. Very seldom. Okay, majority are long term. Okay, actually only Tesla I'm trading. That's all. So usually I will get my clients to invest about 20 to 30 stocks, and all of them for long term. Long term means 5 to 10 years. Okay. Right. So now you have heard from me, hear from me all the slides that you've seen, and you heard the market update, the stocks that you may have to let go, and the potential opportunity to buy in the midst of bad news. I want to invite you to speak to me. So now I'm looking for an individual who may benefit from my services. So, you may ask like, how can you benefit is that if this actually represents your, what I call your pain. Okay, example, maybe your portfolio is making losses and you're unsure what to do. And whether should you cut loss or wait for the recovery, confused over too many investment options, no time to monitor, regret not taking profit earlier, regret not cutting loss earlier, or simply just completely not interested. Okay, and because you allow interest, you either never get to invest or you invest but you don't care. Okay, and you left your portfolio to rot lah. So if this is so, but I would like to invite you to contact me lah. So how can you be my client? Is that first is that you need to be eligible. Example, you need to be a positive person, right? Because only a positive person can see opportunity in midst of bad news. If you're a negative person, then investment is definitely not for you. It's not a cup of tea for you. Second thing is not a trader, as my approach will not be suitable. Trader tends to expect fast result. No, I'm not a fast food restaurant, so there's no fast result for you. Okay. Third, an investment amount that's meaningful to you, not to me, but to you. So what is the meaning amount of money what is meant by a meaningful amount? Let me give you an example, right? So if you to go Google call CPF retirement estimate, it will tell you how much money you need for retirement. For example, okay, they say how much will I need to get a desired money income for a fixed period. So this we start, and then what is the age? Maybe you're 50 years old. Okay, let's say 45 lah, because most of you looks young. Okay, and then what is your desired money income today's value? So let's say today's value is 3,000. And then how long is it going to last you? Let's say you retire at 60 and then and your life expectancy is 90, so it's 30 years. And what is your current income? I checked this current income thing is not necessary. Okay, I just put for this calculator, the current income is not necessary. Okay, and what is the return on investment during retirement? So it depends on what you do with your money. If you're going to put in fixed D, then it's going to be 2.5%. If it's going to be, let's say, REITs, you take 7. If it's going to be stocks, let's say you put 7. So let's say, it's only 5%. And the inflation, so inflation, let's say put 3.5, and then you calculate, right? Okay, let's bonus, you put something. Okay. Yeah. So it says here that to retire at 65, you need 1.7 million. Okay, 1.7 million is the amount that is meaningful to you. Okay, meaningful to you, 1.7 million. And how to get 1.7 million? So it depends on how much you're going to invest. Because let's say if you invest with me, let's say that's $500 a month, you will never reach your 1.7 million. Okay, you will never reach there. Or let's say you invest $1,000. No matter how much you grow, it's not going to reach 1.7 million unless it's the next Microsoft. I'm not so sure if you invest 1,000 in Microsoft when it does IPO, whether will you reach 1.7. I'm not so sure about that. So it has to be a meaningful amount to reach your financial target. Okay, so you can play around with this CPF calculator. You just Google CPF retirement estimator. This one, yeah, and then you get a rough estimate already. In fact, CPF has a lot of calculator you can try, right? And I don't have a minimum amount to invest with me, but I do require you to invest a meaningful amount, okay, to reach your financial objective. So now you may ask that, okay, so what is the service specifically what the service I provide is shown on this slide here. Okay, there are two services, one for wealth accumulation, which is stock investment, the other one for dividend paying portfolio, mainly for retirees. Okay. So the US the stock portfolio focus mainly in US, but although I'm not close to other, I'm still open-minded to other stock exchange, but currently right now there's too many opportunities in US, so I'll just focus on US first. And the objective is to achieve 10% a year for long term. So stock management is meant for wealth accumulation, and then the right-hand side dividend paying portfolio is mainly for retirees to receive a passive income. Aim to deliver about 5% in yield in a diversified portfolio of REITs, unit trusts, and perhaps even stocks. So for both the fees is the same, $3,500 onboarding fee plus GST. Remember GST 8% this year, next year 1st Jan 9%. So there's also some urgency that even you're not prepared to invest now, but it may be next year, you should pay the onboarding fee right now. I got one client who paid onboarding fee this year, although he only you will start in April next year because he has got some money that's going to mature in April next year. So lock in now. Okay. So the fee is same for both 3,500, and I don't charge an upfront fee for any investment, and don't have and there's no upfront fee for the company. Not like it's like the upfront is 3,500 it's flat okay, flat per family. So what I meant by family is that per family means that it's defined as yourself, your spouse, and your children, the immediate families. Your parents will be considered as separate family. So 3,500 per family, and 1% per annum of retainer fee. Okay, to give you some idea of how a portfolio look like, for example, like the dividend, I can see some of you are retirees, some of you here I know who are retirees. So let me show you the dividend one. So for example, like dividend, like this kind of mine, $1 million portfolio. Okay, actually 929, and every month he's getting 3,000 to 5,000 of dividend every single month. Okay, so just imagine if you're $1 million, the dividend payout is average 50K a year, and depending on risk level, there could be even capital appreciation. Now, imagine having this income even without working, without worrying about writing report and pleasing your bosses, and you're free to go on vacation because you know that money just keeps on coming like opening a tap that flows continuous stream of water. I know some may be thinking that whether 1 million is even possible, but let me assure you that many of my clients started with me small. The other day, I was speaking to one client, and he was complaining to me and shocked that my fees he was paying was more than $10,000 a year, any retainer. But when I reminded him that his portfolio has exceeded $1 million, my 1% is actually 10,000. So he was shocked again that his portfolio has really reached more than $1 million because he started with me small. More than 10 years ago, he only did it's just a couple of $1,000s a month in regular investment plan. However, due to the returns of portfolio, the power compounding, and as well as his discipline in saving, because he got in the bad habit of saving, he top up subsequently, wherever he has bonus or when he income increases, he increases his monthly investment. Now he has exceeded 1 million already. Okay, and he's still telling me that he's still eating at hawker center. So I have made many millionaires, but they're all still eating hawker center because they don't realize that they have actually become they are so wealthy now. And all this it's not magic, it's not some magical sign. No, okay, it's just power compounding, discipline, and getting reasonable returns. So I want to encourage all of you the importance of starting early. Let's say if you're working, I want you to come to me to start early and let the good old-fashioned power compounding does the job. If you are already retired, I also can help you because to actually make your money work harder and to stretch your money longer, and so that you can really enjoy life and without worrying about having a run out of money when before your life expectancy. Now, some of you may ask that why should I set such a criteria of looking for a positive person, not a trader, having a meaningful investment from my point of view. And I set three criteria, right? Now, the reason is because I'm selective in the clients I take in, and I wish to keep my clientele small. You see, although I have a team of staff helping me, I still wish to keep my client base small so that I can do a good job in servicing everybody. Moreover, I'm busy traveling. I travel half the time. This year, I've already traveled to a few places like Vietnam, Japan, London, Spain, Germany, all for leisure. And here are some of my photos that I want to share with you. Okay, some of the photos here. Now, I think you can see from my photos that I'm living a rather carefree retirement lifestyle. And it appears that I have retired. But no, I'm not retired. Retirement isn't about stopping work. It's been financially independent. Now, contrary to popular belief, retirement is about enjoying the things you love most. And I want to inspire you to enjoy the things you do like. And if you become a client, let's enjoy together. Okay. If I keep on traveling, then how do I work? Now, this is thanks to the ability to use technology to work from anywhere. So I can conduct my webinar or do a Zoom meeting anywhere, and without even being in Singapore. And I thank my team of staff who work at the background. Now, despite my busy schedule, okay, I still have time to work. Now here are the slides for the two service again. And maybe you can take a screenshot or a picture, right? Okay. Therefore, at this point of time, I want to ask you to contact me to speak to me by scanning this QR code. And when you submit this form, myself or my PA will contact you to arrange for a full 10 minutes phone discussion. So this 10 minutes phone discussion is just a short call where I will ascertain whether can I add value to you. If I can add value, I'll be pleased to have a more detailed discussion with you on a separate day. Otherwise, I'll be so thankful to know another person. So as you're filling up the form, I have more pictures to show you. Anyway, I'll post the form in the chat. Okay, it's in the chat already. So, okay, so as you fill out the form, I also enjoy meeting my clients because all my clients become my friends. And so this is a motivation for me to continue to provide this service to you. So here are some photos for you to take a look. Okay, these are some photos since 2006, 2007. And here are 2011 photos, 2014 photos, young family. This is a middle-aged family. This young family, this client of mine just gave birth just a few months ago. And then, this marvelous young lady here, I got to know her since 2019. And this young family too, just married during COVID itself. Yeah, interesting. And this guy just finished his postgrad. He's been working for some time already, but recently his company sent him for postgrad study. So all these are all my existing clients who has all become my friends, and let's enjoy together. Okay, these three photos here, they are something common. They are all working in healthcare. So this couple here, they are dentists, just started work. This will be, they started work 1 year already as a dentist. And then this lady, she's a nurse. And this couple, they are physiotherapists. And this is a team I'm in the Financial Alliance. I do not work alone, and we work as a team. Okay, and so this is the contact me form for you to fill out. Anyway, regardless of whether you fill or not, I will still contact you to ask whether what are the areas that I can assist you in. So in the meantime, I have a video for you, and after this video, that will be the end of the webinar. So enjoy this video, and in the meantime, you can type in the chat group if you have any questions you want to ask me. If not, I'll contact you directly anyway. If you have provided a valid phone number, I'll contact you and speak to you again. This is a video, Boon Keng, who gave a testimony of my services.
The performance of the returns of the portfolio was more than what we expected. Even for the last year, 2022, which is a very, very bad year for stock performance, our whole portfolio are still above water. Hi, my name is Boon Keng. I used to work as an account manager in the chemical industry. That was about 7 years ago when I was surfing the internet, looking through some of the blogs, and he was contributing some investment articles in the Straits Times. And that's where I first get to know there's this financial advisor called Wilfred Ling. After going through some of his blogs, then I thought that, oh, maybe I should meet him. So before I meet Wilfred, I have also go to a couple or several financial advisors, and then I start to realize that most of them are limited in providing their financial products because they could only recommend their own products, which may not necessarily be the best product in the market. And the second point is when it comes to investment, they seem to be they are very narrowly constrained to managed funds and unit trusts. That's where I find Wilfred Ling is different from the rest. Firstly, he's an independent advisor. He's able to provide or offer, recommend products from across all the insurance companies, and therefore he's able to find the best product that's most suitable to my needs at that time. He's also the only one who's able to recommend stocks beside unit trusts and managed funds. And that's the part that I was looking for at that time because I wasn't investment savvy. I need someone to guide guide me, or me and my wife at that time, to do investment because we know nothing about it. In fact, Wilfred's strategy was pretty simple. Every month, he just say, you two allocate and then put in this amount of money, invest in funds or the stocks that he would recommend. And over the last 6 years, the performance of the returns of the portfolio was more than what we expected. Even for the last year, 2022, which is a very, very bad year for stock performance, our whole portfolio are still above water. In fact, what I would call it, his advisor, a trusted advisor who has become a friend or a family. And he's a no-nonsense guy. He will cut through all the noises, whatever is in your head or in the market, and tell you straight to the point. He has this wide range of experience from all walks of life in terms of his client portfolio. So with that, he's able to recommend suitable product for us. There's only one person I would recommend to my friends and my families or whoever I need to. That will be Wilfred. He is my go-to person in terms of financial planning, and he should also be your go-to person for financial planning. He doesn't treat every client as a client. He treats every client as his friend. So the way he handles it, it's like, I want to be your friend to help you reach your goal, your retirement goal, or to have your wealth protection. This, I think, Wilfred has a lot of advantage, or it's what we can see in him, but not in some of the other advisors.
All right, that's all for today, and I'll contact you shortly, maybe today or tomorrow. So, okay, that's all, and have a good afternoon, and God bless. Goodbye. Bye, everyone. Bye, BC. Bye. Bye, Hong Hang. Bye, Stephen. Bye, Wumi.